Okay, well, welcome to this lesson. In this lesson, we're going to talk about index investing, and there are certain different options of index investing you would want to do. Now, in the previous lessons, I talked about more money you put into the market, the more you're going to get out, obviously, in the future. That's really, I mean, that's a basic concept that you guys should have, that you guys should understand. Like, the more money you can put in really into the market, the most effective way every year, the more you're going to get out in 50, 60, 70 years, for your retirement per se. This is a platform by Thinkorswim, and right now we're looking at the S&P 500 index, which is called SPX. And in this index is the S&P 500. It tracks all the 500 biggest market cap companies in the world. So it's a very safe index. Now, you can see that right now, because it's 2023, the market's come down ever since and it's gone up. These are now technical indicators, and I'll talk about that later. You don't have to worry about this. I just want you to look at the price pattern of what's gone on, right? And the technical indicators you guys will learn in the lessons upcoming. But I just want you to look at the charts overall and the candles. Now, for some of you, I'll talk very basic candle formations, even though there'll be a complete lesson to understand candles as of itself, because that's what I teach in the stock trading and option trading. And I'll give that same technical analysis for the investing too, so you guys can understand at least candle patterns. That way you know what you're looking at. Right, but I'll explain that right now so you guys can have a very, very basic concept. Let me move the camera up here so you guys can see at least. I'm just gonna explain to you very basic ways to look at the charts. If you guys saw about a few seconds ago, in the markets, in technical patterns, there's different ways to look about in charts, but the best way that I've found, a better way to look at technical analysis in terms of looking at price movement, is the candlestick patterns, right? So candlestick patterns were created, I think, back in the 70s, like late 70s, and it was created in Japan. And the reason why they're so effective is because they show you price close by the bar coming down and the price open too. And it shows you the tails of the price going down and going up. So I'll explain about that, because maybe you guys are a bit confused on what I'm saying. So the markets for candlesticks, you're always going to have only three types of candlesticks. Always. You're going to have a green candlestick, and you're going to have a red candlestick, and you're going to have a doji candlestick, right? Maybe so some of you might be saying, okay, what's the difference? I'll explain about that. Let's first talk about the green candlestick. And I'll mostly, there's going to be a lesson dedicated towards this, right? You guys will know exactly what the candlestick is, but I just want you guys to have a basic understanding, so then I don't want you to be lost when I'm talking about when the market's going down and going up. Right? So in a green candlestick, in any candlestick, you're always going to have an open, and you will have close. Right? That's simple. What does open mean? The open means, which is open price, and this is close price. What that means is, for example, right now the market is closed. On Monday it opens. When the market opens in New York time, the market opens at 9:30 a.m. in New York, right? And the market closes at 4 p.m. in New York, right? So the open price means that the price of, what was the price of Apple when it opened, when the bell rang, right? The bell rings whenever the stock exchange opens, and the stock exchange opens always at 9:30 a.m. in the morning. So let's say that Apple opened at exactly at 9:30 a.m. at $170. So $170. And then and this was at 9:30 a.m. This will always be like this. It will always be like that. And then it closed at 4 p.m., let's say $180. Right? So the price went up. Apple went up. So what that means is, if Apple opened, right? Apple opens right here. You're always going to see this. It opened right there. And this will represent the open. And it opened at $170. The good thing is that, Apple went up. Right? Why did it go up? Well, because at the close, it closed at a higher price than what it opened at. It actually went up by $10. So every time a stock or any security goes up, you're always going to have a green candle, because that represents bullish behavior. The price is going up and closed above. So you're going to have a body candle like this. And this will be the close at 180. Right, so we're looking at Apple, and the price went up. So that's that simple. That's a green bar. Now, sometimes in the not sometimes, but all the times during when the market's open, the price is obviously going to be fluctuating, right? When the price opened at 170, you're going to have sometimes the price went down, the price went up. It fluctuated all the time. Like maybe when it opened at 170, probably an hour later at 10:30 a.m., it went to 180. I mean, sorry, it went to 168. So the price went below the open, right? But 3 hours later, it went to 178, and then it ended off closing at 4 p.m. at 180, right? So by that nature, right, the price fluctuated during the market open. So during the fluctuations, you're going to have tails, right? So maybe some of you might be saying, okay, what's a tail? All right, let me show you. Remember that I said an hour ago that the price went down below the open. When it goes below the open, you're going to have a red candle, right? Because now the open's on top instead of on the bottom, and the closing was below, right? So the price went down. This will turn it to a bearish candle, right? But temporarily, it didn't close yet at 4 p.m. It's just during the market's open, it's below the open, so it's a red candle. So what you will have is that when I said that an hour later it went to 168, what you're going to see is during the day, you're going to see this. You're going to see that this candle will have like a tail right there, and that tail represents the lowest the price went, which was $168, and that's called a wick. Actually, there's a lot of terms of what it's called. Let me put that here because you guys can't see. There's a lot of different words people call it on Wall Street, but people call it a wick, people call it a tail. I just call it tail. Right, 168. That's for the bottom part. The same thing happens on the top part. Sometimes you'll see that the price has gone up way too much, right? The price went up a lot more. But let's say that when the price went up at 3 p.m., and let's say it went to 183. So it went up and it went to $183. But it went back down, right? And then when it went back down during the close at 4 p.m., it ended off closing at 180, right? So you guys understand that the wick shows of where the price has actually gotten past either the close or the open. If the candle, for the tail above, that just represents the highest price the price went in that day or in that candle, depending if you're looking at it an hour or daily or weekly. It's the same. If you're looking at a weekly candle, it will show you the highest price Apple went to in that week, which would be this head. It's called a head or a tail, which was $183. And then this bottom tail, which is the wick, shows you where the price has gone the lowest in that week or in that day, which was $168. But it's always going to open at 170. Nothing's going to change that. But it decided to close at 4 p.m. at 180. And wherever it closes, that dictates what color the candle will be in that time. So if you're looking at a daily candle, right, if the price closed above the open, that's always going to be a green candle, right? So it always dictates it. If the price closed below the open during at 4 p.m. in that day from the daily candle, this would be a red candle, right? And it's the same case with the week. The price is going to fluctuate until at the close, if it managed to close above the open, if it closed at 173 or 178, in this case at 180, it's going to be a green candle because the price went above the open. All right, so that's how candlesticks work. And let's talk about red candlesticks. So a red candlestick, it's really simple. It's just the opposite of a green candle. It's the exact opposite. So this is a red candle. The open is always going to be here at the top. And let's say that it opened at 170. And over here, it closed at 4 p.m. if it's on daily candle. If it's on weekly, it will be on Friday. It opens on Monday and it closes on Friday because it's a week. In the weekends, the market's closed. They're only open on the weekdays. And the weekend closes at 4 p.m. on Friday. And it opens on the week on Monday at 9:30 a.m. That's simple. Let me change the color because you can barely see that. Let's say that it closed at 160. Right, so it's the opposite. You see, it's like the opposite. It opened at 170, but because the price went down, it managed to stay in that area and it managed to close at 4 p.m. at $160. This is going to be a red candle because that represents that the price went down, and a bearish candle. Now you have the tails. In the tails, there's no difference. The tails now are for the top. It's the opposite now. For the top, this just shows you the amount the price went up before it went down It shows the highest price, the price went up in that candle. So if this is a daily candle, we'll show you the highest price, the price went up during that day. And let's say that it went to 173. So that's the tail. And let's say for the, or no, sorry, that's the head. For the tail, let's say it went down to $156. But that's the lowest, but it managed to go up above and close at 160. But net in total, this is a bearish candle because it closed below the opening. So it shows bearish sentiment for the day. That's how candlesticks work. That's how candle. It's very basic. It's just whatever the tail is, if the tail will represent whatever the lowest on that tail is. If it's 156, that's the lowest price the price went to during that day. The tail on top will show you the highest price the price went through on that candle or day. If it's on day, if it's on week, it will be a week. If it's a month, it will be a month. The open shows the opening price the candle opened on day or week or month. If it's a daily candle, it will be 9:30 on the day. On the week, it will be at 9:30 on a Monday. And for the close, it will be the closing price at 4 p.m. on that day for a daily candle, right? That's what it means. So yeah, it's the same thing. For this case, because it's a bearish candle, the close is going to be the low, and so that the tail will be lower than the close, managing more bearish sentiment. But the bulls were able to bring the price up and put the price at 160. But net in total, this is a bearish candle because the price was lower than the open. The bears were able to manage to bring the price much below, then the bulls were able to bring the price up. So it's a net bearish candle despite the tail going on. And yeah, that's what that means. And yeah, I'm gonna also obviously I'm gonna talk about very in-depth candles, like what candles you should look for. I just want to explain to you what makes a candle so you guys can understand that. So now looking at this, you guys understand this now. So this is a bearish candle, this is a bullish candle. You can see that net in total, it's a bearish candle. That's why the price went down more than when it went up. So let's talk about index investing. The more you invest, the better your return is. Now there's several ways to invest in index investing. I'm going to explain to you first the most basic one, which is really the same thing as what I've explained before, right? The most basic rule, and let me go back many years ago. This is also weekly candles. So you can see it's weekly. And let's go back maybe towards, I don't know, 1970. Let's go like to 1973 per se. So it's at 1973. Let's say there are several ways to index invest. Let's say that you're going to invest manually. Or let's say the most easiest one. Let's say that an easy way that you can invest is investing every year, right? And you're going to invest a certain amount. The best way to do this is what I explained before, like that 60-40 rule, meaning that if you're making about $180,000 a year, so it's about $15,000 a month, $3,700 per week, right? So if you're making about $15,000 a month, then your expenses must be about $9,000 maximum. What I mean by that is like they don't have to be 9,000, but that's the maximum. Of course, it's better to have it lower because remember, the more you invest, the better. For me, like look at my rule. My rule, I don't even have the 60-40 rule because I don't have much responsibilities, but this is what my family, this is what my parents do. And they do pretty well on that. I actually have 20-80 rule, or sometimes even a 10-90 rule, right? And what does that mean? Because I don't have much responsibilities. I really invest all my money that comes into the market. I don't spend anything, right? If you were to talk to everyone who knows me very well, and that I still talk to, obviously, but at least all my friends that know me, I don't spend anything. I rarely buy anything. I rarely look, for example, this phone I've had this phone for about 5 years. I haven't changed it at all. And you can see it's in perfect condition. And I haven't changed anything. I haven't gotten any iPhones. I don't have an Apple Watch. I don't have none of this stuff. And I don't need it. Why don't I buy it? Because I don't need it. This phone gives me everything. I can look on YouTube. I can search information. It gives me great quality of camera. I still have a lot of storage. Why do I need to switch on an iPhone? Right? But I understand the business model of it. I understand the business model, but I don't need to buy another iPhone. Right? So that's one thing. The computer I'm using. Now, I have a monster of a PC, but that's just because when I was 15 or 14, I was so involved into YouTube that I needed the hardware good enough so I can produce as much videos and editing I can have, right? I've had this PC for about 6 years. I've had no problem with it. The PC costed thousands of dollars because it has high-end hardware, but I haven't changed anything, right, since 6 years. I have another laptop that I've had it for about 7 years. I haven't changed anything. There hasn't been any damage. It works perfectly fine. It's on a MacBook. It's a Lenovo. And That's it. I don't have anything else. Yeah, I don't have anything else. I just have this microphone that my dad has because he sometimes plays music, and then other stuff that I have here is literally stuff that I've had for 5 years. The only thing new that I've bought has been maybe these two posters I have here, which costed $30 or something. This LED light, which I bought 2 years ago. Well, that's about it. Like I haven't bought anything new just besides clothes or something like that. I've bought like, but I think ever like for the past 5 years, I think I've bought in maybe 6 shirts. That's it because I'm growing. I'm still, in my age, I grow a lot, but I mean, that's about it. I don't have anything else. In terms of expenses, I don't watch Netflix. So I don't pay Netflix. I don't pay any gaming. I don't play really as much games at all anymore. Despite I did have a few things on my desktop, but that's just because before a long time ago I've had it, but I never really thought about moving that out. Now I did recently. I mean, I don't pay any subscriptions. I don't do anything of that kind. The only thing I pay for online is my office equipment like Microsoft 365, and then of course, business expense with this selection. I mean, that's like about it. I don't have anything else. And I spend everything I spend, which I will talk about in a video. I spend it all on a credit card. Listen, I'm at a young age, but I have a lot of people who are surprised about sometimes the certain credit cards I have. I spend everything on credit card, but I don't spend it. And many people have a bad mindset about credit cards, but that's because they don't understand and they never got fairly educated about it. I did because I did the research. I learned from people who actually have a really good credit, and I did the same thing, and now I have a really good credit score. And I'm not shy. Right now, my credit score is actually it's almost 740. It's like 738, right? And I started like almost 2 years ago, very quick. And I think I spent by average about $30 per month. And max, I spend like 6% of my account. I don't want to go into full details. I don't want to explain that, but you see the basic things. And whatever my credit card is, I never leave a balance. Whenever I pay something on my credit card, I literally pay it the next day, or best enough, I pay it immediately after I purchase the item with the credit card. That's because the most thing that fills your credit score is your payment history and it's the utilization rate. Those two things. And there's a bunch of other important factors, but those are the most two important factors. So I never leave a balance. I never use more than 10% of my account. So if your account is $10,000, the max you should be utilizing is $1,000, the max, and never leaving a balance in per month. I don't know who was the idiot that said that leaving a balance in your account would help your credit score. Not at all. Think about like if you were a lender, would the person that you're lending to, would you like that they had a balance in their month? No, that's stupid. No, you don't want that. And that's why I have my credit score like that. But out of all this, reason why I explain this because I utilize my spending smart, right? Everything I spend is on my credit cards. I almost never spend anything on my debit cards. And the reason why I do that is because in my credit in the future, if I want to get a loan for a house or for a business, I'm going to get the loan so easily and I'm going to get such a small down payment. But it's because I made responsible decisions in action. I'm actually not using much of the credit I have. I have activity, of course, and I utilize my credit very responsibly, which is using very low amounts and paying it fully, way before not the due dates, because people don't understand. You don't want to pay, it's not the due dates. You always want to ask the report date. The report date's the most important thing, because your company of credit is not the one that's giving you good credit. It's the credit bureaus. Those credit bureaus will be the TransUnion, Equifax, and I don't know, it's called like credit something, but these three important unions. Mine's TransUnion. Mine gets reported to TransUnion. So I remember every single time I open a new credit card, first thing I do, I don't do anything else. The first thing I do is I ask them when I open my credit card, the first thing I do is I say, hey, whatever, what's my report card? I mean, what's my report date? Right? And sometimes they'll be confused on what you're trying to say. And you have to keep explaining to them about what's the report date. I'll talk full how to answer and how to talk to them effectively, what to ask and what you should do based on my experience. And I know a lot about credit. I know a lot about credit, especially business credit too. Although that one's more fairly new. I have more experience on personal credit. But yeah, the most important thing is your report date, because I mean your report date is the time when your statements are going to be sent out to the credit bureaus, and the credit bureaus is what makes they're the ones who make your credit score. So they're the most important entities more than your credit company. Your credit company is just a third party provider to bring it to the credit bureaus, but that's really important. The credit bureau is what dictates what credit score you're going to have. So you want to make sure to know like when's the maximum day that I need to put this money in before these important entities are the ones changing my credit score. So if you report your statements flawless all the time, they're going to give you a really good credit score. That's simple. All right. So at any rate, what I was explaining about all this is that you can see that I spend very little. I spend less amount. That's why it's also because I'm so serious about investing. Every money that comes in, I put it into my accounts for the market, for investing, for trading. A lot of it goes more towards investing because I know all the money that I'm going to put in, that's my future. That's especially because of trading and investing. I invest a lot in businesses that I will get in return in 20 to 10 years that I'll have, I know for sure, millions of dollars and hundreds of millions of dollars as years come by because of the quality investments I make. Right, but I can't make these quality investments if I don't put more money in. So that's how it works for investing. But you first have to know what you invest in. You have to know exactly that I've been able to do this because I have a lot of experience with investing. So I wouldn't advise you to put a huge sum to a big business when you're starting to the market. I recommend you to get experience first, understand realistically like what makes a good business, and then that's up to you if you want to invest a big amount. Right. So at any rate, I have a 20 to 80 rule, a 10 to 90 rule. But you don't have to. I'm just saying that, remember, the more you invest, the better your return will be. So I would say if you can definitely if you can see that you can get that 20 to 80 rule, like what I do with the 10 to 90, I mean, that's even better, right? The reason why I have a 20, in fact, I actually want to have 100. I don't want to spend anything, but I can't do that. I have to pay stuff with my credit card. So that's the only thing. The 20 is just my credit card. That's all. It's like, I don't know, my toothbrush or my toothpaste or my shampoo or shaving, all necessity items. I don't buy anything that I want hugely. I don't do that. I haven't bought anything in a long time that I, let's say, and also I don't want to because I'm always doing this. I don't feel the need to buy anything. Many people won't. So, but again, remember, the more serious you can get about all this stuff with investing and changing yourself, the quicker you're going to become wealthy, really. The quicker you're going to find the opportunities that you're supposed to do. But I wouldn't advise you to have this let's say that you need to find the quick way or none of this stuff. No. It's just I do the quickness because I like what I'm already doing and I don't mind the quickness work. I like doing the quickness work and I've always done it and I've adapted to it. You don't have to do that, but it does deliver better results. Talking about this when I talked about the 60-40 rule. So if you're making about $15,000 a month, really the expenses that you should be paying should be about 60% of that. So that should be $9,000. Every expense, leisure, entertainment. What are my total expenses? It's everything I spend after I invest, right? Because the first thing that you should get in, the first thing that you should ever do when you get money is not to spend it on any of these expenses. Not to spend a new dress on Amazon or a new iPhone or a new cool gadgets on Amazon. No. It's you want to invest that money first. Whatever comes afterward, whatever money you can do, that's free up to you. And I actually advise you, if you really see that you don't need to get something necessarily, then I put all the money to investing, all that other money to investing. If you don't have, let's say, responsible bills like electricity or mortgages or none of this stuff. Of course, if you have mortgages, you should do that. But even if you do, no matter what necessity bills you have, you need to invest first when that money comes in. Regardless, you need to invest that money first. And that money will be, if you're making $15,000 a month, then that will be 40% of it. So $6,000. By the time you get $15,000, first thing you ever want to do is get 40%, and that'll be $6,000. That $6,000 will immediately go to this S&P 500 if you're gonna do this investing this way. So you want to put $6,000 immediately to the S&P 500, and the rest of the money, that's up to you if you want to invest more or need to pay necessary expenses. But always keep this 60-40 rule. 40% goes to here, 60% goes to expenses. Now that's one way to go about per year, right? So then by the time you're doing this, let's say that's the idea. That's actually called dollar cost averaging, what I just said. It's called dollar cost averaging. That means that by every time you're investing in the market, you're always going to invest every month, or let's say every quarter, right? It doesn't have to be every month, but I recommend you to do it every month so you can at least be disciplined. You can have money actually in the market, not right, because you're able to actually you're going to be able to buy at every point. You're going to be able to buy when the market's come down, when the market's gone up, when the market's gone down more, and you'll be able to keep doing that. And the great thing about this is that, let's say, for example, if you always make $15,000 per month, the great thing about this is that, let's say that you bought the S&P when it was right here. So it was at $96. And then a month later on July, because this is on weekly. Just keep in mind this is on date. This is not daily. This is weekly. So on June, then until July, which was a month later here, it was at $891. So if you invested $6,000 here, which would actually be here, it would be, let me get the calculator. So watch, 6,000 divided by that price, which was $97.39. Okay, you're going to buy about 62 shares, rounding it off. Now, just keep in mind that you can't buy the SPX. You can't do that. I'll talk about eventually because that's a bit more detailed on the only way to invest into the SPX is actually investing on either an index fund or an ETF tracking the S&P 500. Right? An ETF is an exchange trading fund. So the only way to invest in the S&P 500 is to invest in a fund that's tracking the S&P 500. But the best funds that you're going to find to track the S&P 500 will be the Vanguard S&P 500 ETF, and it's going to be the SPY ETF, which is the standard. It's the SPDR ETF tracking the S&P 500 ETF. The other one is the Vanguard S&P 500 Index Fund, right? So you might be saying, okay, what's the difference? Well, I'll talk about that eventually, but the best one that I invest in personally is the Vanguard S&P 500 ETF. The reason why I do that is because that ETF has actually a lower expense ratio than the Vanguard Index Fund, and it has a lower expense ratio than the SPY ETF. So I found it much more better to, and there's no difference. There's no difference between the three in terms of, because they both track exactly these movements. The only difference between them are their expenses. You always want to look for the lowest expenses because that's going to maximize your returns much more. So, but at any rate, let's say that you bought 62 shares into the Vanguard ETF, which is called VOO, VOO. That's the ticker symbol. So you would type here VOOO and you would get the Vanguard ETF. But let's say you bought it here again. So you bought 62 shares and then you put $6,000 here again, or no, yeah, here, and you would buy it at a lower price. So it would be $92. But now this time, what's going on is that with $6,000, you're buying at a lower price, which means that in total, 91.8, look, you're buying more shares. So that's great. Why is that so effective? Because you will see that as the price goes down more, the more shares you will buy. And that's really great because remember what happens when the market goes down more, it's likely to go up. So this is amazing because the more the price goes down, you're able to put more shares. And when the price is going up and up and up 90 degrees, you're going to enter less shares. So net in total, you're going to have like an average position of higher highs and higher lows. I love dollar cost averaging because it's impossible to lose. It's even more harder to lose than to invest just once a year. Now, you can do that every month. If you can't do it every month, I would say do it every quarter. So that would be about 4 times per year. So let's say the first quarter would be January. The second will be maybe February or close to March. The next one would be on May, mid-May. The next one will be on August. And then the next one would be like November and December. So it's about 4 times: January, May, August, and November, December. That's about 4. So let's say obviously these 4 times, because you have much more cash. Let's say from $15,000 per month. 12 divided by 4 is about, well, really it's by well, it's not 4, but what's 12 divided by 4? Okay, it's about 3. Okay, so you would multiply, so $15,000. Multiply that by 3, because that's by average like 3 months or so, you would have about $45,000. Of course, 60% is, so with this money, because you're obviously going to pay expenses per month, let's say you have left about 60%, because that's your goal on expenses, right? You can't do the first money to invest because you're not dollar cost averaging per month. You could dollar cost average per quarter if you get paid per quarter. If not, then you can do it per quarter if that's better for you, if that's more flexible in terms of your financial stability. You would be left with about $27 from 40% of 45,000, I think it was. That means $27,000 you would invest in January, so it'd be here, and you would buy about 101. So you would buy 267 shares, and then the next quarter. Oh, okay, my bad. No, my bad, because that's 60% of expenses. 45,000 times 40%. Yeah, divided by 40. All right, so let's say 40% will be 18,000. So you're left with $18,000 free. You would enter it here on the first day of the year. The first day or the first week, doesn't matter. Or hang on, 18 divided by 101. Sorry, 178 shares. All right, so I want you to look at this picture here, this image. And this is an example I made so you guys can understand this sort of method of investing, right? So your income, right, this as an example, let's say it would be $15,000 that you're making per month, and you're going to do the 60-40 rule, right? So the first money you're ever going to touch is from that 15,000 will be 40% of it. So that'll be $6,000, and that $6,000 will immediately be invested into the S&P 500. And the remaining 60%, that's up to you to spend or to reinvest, but you are required all the time when you get your money to invest a percentage like this into the S&P 500 if you're going to do, obviously, index investing. That's what you're going to do, right? And the rest of the money that can be spent for all your expenses, right? So I've already told you before, you just have to adjust in which way you want to either reduce expenses or get more income, right? There's many different ways. In this example, we're going to talk about a method called dollar cost averaging. Dollar cost averaging just basically means that you're going to invest a certain amount every single time for a period of time. So what I mean by that is, let's say you decided to invest about $10,000, and with that $10,000, you're going to be investing this amount automatically every certain period, right? So let's say in this example, we're doing it per month. So just like your bank account, like if you were doing this like in your bank account, it's no different, right? In dollar cost averaging, you're not looking at the charts, nothing like that. You'd automatically invest into the market every month, regardless where the chart patterns are, whether it's going down, whether it's going up, it doesn't matter. You're just putting money into the S&P 500 just as it was a savings account. You wouldn't care what time it would be. So in this case, you're going to be investing $6,000 per month because you're making $15,000 per month. So let's say for month one, the price was at $100 on the share price and you invested $6,000, right? So that would mean that you would buy 50 shares because that would be about $6,000 worth. Now, a month later, the price went down and went to 80, and then you invested again $6,000, which now you bought 75 shares, more shares, right? And then you can see that by the next month, in month 3, it went to $90 and you bought 67 shares, which was $6,000, right? Because 90 times 67 shares, that's the closest rounding to $6,000. Then on month 4, it went down again to 86, and you invested 70 shares, which were worth almost $6,000 or $6,000. Right, so you can really see that by this pattern. You can see that as the price goes down, you actually buy more shares, obviously, because the price per share is less, which means you need to buy more shares in order to have it worth in total about $6,000. And that's really good because you're going to see the value of doing all this, because you're going to see that the more the price goes down, the more you're automatically going to buy more shares than what it was up higher. And the higher the price goes up, the less shares you're going to enter. Right. This is very, very safe. I would say that it's really impossible to lose money like this in the long term. I think it's impossible. There's no way, right? Unless the country, collapsed. But that's, that's a very low probability. If the entire country collapsed, like hundreds of companies would go probably bankrupt, to be honest, or it would be really affected. So, every asset has a risk, but this risk is not. It seems it's a very unrealistic probability. So yeah, as I said, as the price goes up, you buy less shares. You bought 57 shares at 105, 126 in the share price. You bought 48. The price went down to 110 a month later. But you can see that you're just investing every month, regardless of where the share price is at, right? So out of all this, the price went to 132, went to 145, and each one you invested about $6,000, right? And then when the price went down to 130, you bought 46 shares. You bought more than what you bought it when it was higher, right? Because you want to equate the same amount. So what's the effectiveness of doing all this? Well, you're going to see. So if you look at this chart right here, this is a bit more detailed to what you saw before. I want you to ignore this temporarily until I'm going to explain it. Just ignore this. I'll explain it in depth after I've explained all this. But I want you to look at this, right? So this is the same thing as month 1. You bought 50 shares at $120 at the share price. But then a month later, it went to $80 on the share price. Right, so if you invested over here about $6,000, if you put 50 shares and the price went to 80, you are now losing $2,000, which is a 33% loss, right? However, this is the case if you just bought one time, right? In reality, by dollar cost averaging, this is the great thing about dollar cost averaging. I would say it's really the best way to invest in an index. If you look at this graph here, I'm going to zoom in. These numbers, just pay attention to only this one right here. 1 to 2 stands for month 1 and month 2, right? So on month 1, to this drawdown, we know that we lost $2,000. However, we actually lost 16% by dollar cost averaging. And some of you might be saying, how is that possible? Well, it's simple. We bought 50 shares here, right? But then when the price went down to 80 a month later, you bought again. You bought 75 shares. But if you add the total of what you put in, it would be $12,000. So in reality, if you factor in a $2,000 loss with a worth of $12,000, that's only 16% of a loss compared to 33%. See, and this is the value of dollar cost averaging. The more you invest as time goes on, regardless of the share price, the more it's really impossible to actually get a drawdown, to get at least a negative drawdown in your account. There will be obviously a drawdown while your dollar cost averaging, as like if you were at 20% gain and went to 15%, that's a drawdown. But it's super, super hard that by the time maybe a year later, when you're making a 30% gain, it's very, very hard that you're going to lose. Now maybe you're losing in total 15% of the worth. It's very hard, and you're going to see exactly why. And you're really going to see exactly why, how that's kind of impossible, let's say 5 years, 10 years later, right? Unless, I don't know, the market went down by 90%, obviously. I mean, probably, but that's, the market actually has never gone down by 90%, not even in the Great Depression. No, because in the Great Depression, it went down by 60%, but the market has never gone down 90% in its history. So what are the chances of that happening? It's very, very small chance. The market has been open, I think. When was the Dow Jones Industrial created? Okay, 1896. Right now it's 2023. Right, so that's about 127 years. Let's say out of one in those 127 years, the price went down by 90%. If you grab one and you divide it by 126, which is the amount of years, look. Oh no, yeah. Okay, look, this is about a 0.79% chance, right? That's a point. Now, in reality, it's a lower probability, because I'm just saying that if it happened on 1 year, right? If it happened already once, that would be a 0.7, almost a 0.8% chance that can happen. A 0.8% chance, less than 1%. Okay, so yeah, that's 0.8% chance, right? The probabilities are much lower because this calculation is just saying if it happened one time a year, right? If it happened once in 126 years. But in reality, it should be like almost a 0% chance. So I would say there's a 99, I don't know, there's more than a 99% chance that the market will not go down by 90%, right? So yeah, you see, like, that's why it's almost impossible to lose. And even then, if it goes down to 99% chance, even if it goes down to by 99%, in the long term, you're actually going to make more money because you're buying it cheaper. So you see, like, it's impossible to lose money as long as you don't sell, really, if that ever happens, right? But that's a 99%, more than a 99% chance that it won't happen. So by that nature, by that calculation, then we can actually say that there's more than a 99% chance that you're always going to make money doing dollar cost averaging. And that's a very high probability. That doesn't exist in trading. That exists only in investing like that. So I'll explain to you how this works so you can understand, like, so you can be with me with this, because maybe you might be confused, like, how is that so? All right, so you can see that these percentages here are just explaining, like, from month 2 to month 3, that's a 12.5% gain. And then over here from month 1 to month 3, when you bought at 120, now it's at 90, you're losing 25%, right? And then it goes on like this, like 3 to 4, it's 4% loss, 4 to 5, 22% gain, 5 to 6, 20%. And, it goes on 6 to 7, 11, 7 to 8, 20, 8 to 9, 9, 9 to 10, 10% loss, 10 to 11, 3.8% loss, and 11 to 12, 5.6% loss, right? Okay, so I'm pretty sure you didn't memorize all of this, but this is why I have this here, right? So this bubble I have here it doesn't represent the gain per month, but it represents the gains on every position you had. That's why it's called an average position. And I'll explain to you exactly why it's an average, right? But so you can understand the concept of it. We know from 1 to 2, you're losing 16% loss, because 2,000 of 12,000, that's only 16%. So it's like a 16% loss, right? And then counting the buying on 1 and 2 and now 3, right, you have a loss of $750 compared to a loss of $1,500, right? Because this one's offsetting it. This one's helping it. 750 minus 1,500, that's about a $750 loss, right? But if you grab these together, right, $750 divided by 12,000, right, that would have gave you like a 6.6% loss. But in reality, we're not losing 6.6%, we're losing 4.1%. Why? Because we bought again on month 3. We bought 67 shares at $90, so that increases the worth in our position. We have about $18,000 compared to 12,000, and now $750 making up 18,000 would be 4.1%. So it's a 4.1% loss. You see how you see how it gets harder to lose because you're entering each time more and more. So that's why the game here, and that kind of works with stocks, but mostly with the index. I don't recommend this for a lot of companies, even if they're good, and I don't recommend this way, but this works incredibly well for an index fund. I mean, an index, specifically the S&P 500. I don't recommend you doing this for any other index besides the S&P 500. Maybe the Dow Jones, but I prefer this S&P 500 because you have the 500 biggest companies in the world there. The Dow Jones is strong, but it only has the 30 biggest companies, the 30 blue chips companies in the world that have a brand. That's very strong, but it's more stronger than the S&P 500. Do dollar cost averaging with its S&P 500. You can see that by each month as it goes on, rather than losing, let's say, I don't know, rather than losing 4.4% here on month 4, you're losing about 4.1%, right? And then to month 5, right, in the short term, because it went up, these percentages are going to be more volatile, not in dollar cost averaging, but just in A to B, like you bought here and then you left and you didn't buy the rest, right? It's going to take longer for you to make a gain. So you can see that by 1 to 4. So just so you can understand, when I say 1 to 2, right, it doesn't mean that you're taking the gain on the second month. Why? Because you just bought in the second month. We're not on month 3. On month 3, it's delivering you the gain because it's now $90, and this was at $80 in month 2. So you see the difference there. That's why when I say 1 to 2, that just represents the percentage performance from month 1, because you only bought a month 2, but month 2 hasn't made a loss or a gain yet. So that's what it means. So when I say 1 to 5, there's only 1 to 4 of the months. So you have 1, 2, 3, 4 of months that have performed now, and then on the 5th month you've already bought, but there hasn't been any performance there on month 5. So you see, as each month passes, you can see that by 1 to 2, 16% loss. 4 to 4.1, it's a loss. 4.1% loss. 1 to 4, 6.3% loss. And then this is where it starts to gain. 1 to 5, 11.4% gain. 1 to 6, 28.3% gain. And I actually have this here, so you guys can see this a bit more easily. So look, I have this here on the spreadsheet. This represents the dollar cost averaging section, and this over here is just buying if you just only bought on that month, right? So you can see that on month 5 was 11% gain. So you can know these numbers are percentages, same as this one. So this is a 28% gain on the 6th month. On the 7th month, it's a 10.6% gain. And when I talk about the 7th month, I'm talking about all the months in general, because remember, you already bought in these months. You didn't sell them. You still hold them, right? So in total, the total worth from month 1 to month 6, it's gained $6. So you have that gain. And then month 2, it's gained 80 to 126. You know, it goes and so on. You can see that. That's why I have these numbers. It says 1, you gained $1,700. On the 2nd, you gained $450, right? It's counting the gain from the month 1 to month 4. What was the performance there? Or actually, no, sorry, it's actually a loss. The loss of $1,700. Second one was $450, and the third one was $268. The one that delivered the gain was month 1 lost $750, and then month 2 made $1,857. Month 3, $1,005, and then month 4, $1,330, right? And the total cost was $30K. But all this is pretty much summed up here. So month 8, 33% gain, month 9, 36, and then month 10, 20, and month 11, 14, and month 12, 18. Look at what's interesting. You can see that if you compare them both, look at this. From dollar cost averaging, you lost in the first month less than this one. On the 3rd month, sure, you lost, but you didn't lose much, and this one gained. That's why I said at first that, like, in the short term, it's not going to be, in the short term, like in the first 3 to 4 months, it's probably not going to do a big effect. But then when you start to look at it in 6 to 12 months, that's when it makes a huge difference. It's like a different game. Look at this. This was 11, this was 22, but that doesn't matter because in the long term, it will beat it. Look, 28, 20, 10, 11, 33, 20, 36 is huge difference. 36, 9. When this person was losing 10%, you were gaining 20%. When they were losing 3%, you were winning 14%. And you see the advantage here because you're entering the same amount, or of course it's better to enter more when it comes down, but it doesn't matter, right? Like I would say the best approach that everyone should do is really just enter the same amount. If you can, remember what I just said, the more you invest, the more dollar amount you invest into the S&P, the more money you will have later on, right? And I'll talk about that more specifically later, probably in another lesson, because that's also equally important because there's something that many people don't say. But as I said, like the more dollar amounts you invest, the more dollar return you would have later on, right? And that's what you see here. The fact that you're investing per month, you're going to have this. Look, and I put a chart of this. This blue line represents dollar cost averaging per month. That means you're buying every month $6,000 like a savings account in the S&P 500. The red one is just buying on that month and not holding it for the next month, and then buying again to that month and then not holding it for the next month. You can see it's way better dollar cost averaging. Look at this, because in the short term, this did overperform it, but look at what starts to happen. That's why I keep saying like this plays a bigger role when it's in the long term. Like wait a year or so, you're going to see the difference. And there is a difference. Look, while this was -11, this was making 10%. So you see, with every time that the price comes down, actually, in reality, the more you're going to be above 0%. Now, some of you might be saying like, okay, how does that make any sense? Well, because here's the thing. The market never stays at one price all the time, right? When the market comes down, remember, the whole thing that we started since 1928, when the market comes down, the more likely it's never going to be at that price. When the market comes down, the more likely it's going to go up. The sharper the market comes down, the more likely the price will be at a higher price, and the price will always be at a higher price because of this. So it doesn't mean, this is why many people have this mistake, because people understand that, but they don't understand something exactly like that. But many people believe that you have to always buy the dip, that is true, but people believe that you should only buy the dip. For in index investing, you don't have to always buy the dip. In fact, you make a better gain in the long term if you actually invest regardless of where the price is every interval period, right? In this case, it's per month. And I'd recommend for people, if you can actually find a way to invest your money per month, you're going to have a really good return. I would say that's the best approach. If you can't, there's other ways, don't worry. That's what dollar cost averaging is, not just per month. You can actually dollar cost average per quarter, right? So in this case, let's say, I don't know, you're not flexible for some reason to have the income that you have to invest it in the month, but let's say you're able to sum up all this income and invest it every quarter, right? So in a quarter, there's about 4 quarters in a year. That could be January, and then the next one could be May, right? The third one can be August, and then the fourth one can be November or December, ideally December, right? But you're entering 4 times. Of course, now you might be saying, what's the difference? What's the difference between per month and per quarter? Well, we can talk about that. When you're investing per quarter, obviously, I'm pretty sure you're going to be investing much, much more money compared to per month, because you already have much more money to even have in the first place for the quarter, because you accumulated more. So you have more money to invest, right? But you might not have, let's say, the diversity compared to per month. So what I mean by diversity is, like, if the price goes up in 2 years and then comes down, if you compare it to a person who did it per month, they won't be losing at all, but maybe you might. The reason why you might is because you only did it 4 times a year, rather that other person did it like 12 times. They bought at completely different prices all the time. But rather you only bought 4 times in that year, regardless of where the price was, whether it was going up, whether it was going down. You only bought it 4 times a year, right? I don't think this isn't a big problem at all. I don't see that as a big problem, because this is just the long term, right? You're not looking to make a gain for 10 years in the S&P 500. You're looking to hold this stuff for 30 years or for more than 30 years, ideally 60 years if you're young, if you're relatively young. For elderly people, really at that point, like I think even for 10 years to 15 years is still good. I mean, I showed you that the amount of money you can make. If you just hold it for 10 years, well, you will have maybe like a 200% gain. I mean, not a 200% gain, you'll have more than that. Because if you're doing this, I'm pretty sure if a person did this for 10 years and had this amount of money, well, let's see. Okay, so you made about 18%. And the great thing about this, which I forgot to say, this is why it's impossible to lose. You want to know the other huge powerful thing about this? There's two things. The first one is the compound interest. You're already gonna you're gonna outperform anyone who's trying to predict the bottom in the S&P 500 or anyone who's just buying a few times in the bottom. Why? Because of compound interest. We all know the market will be higher. No, it's not going to be guaranteed higher. Anything can happen. Look at the 70s. But that's very unlikely because there's no like cause and effect that can lead that way. Everything is a cause and effect. There's no reason for that. There's no like bad practices or consequences that we've done over the past few years that hasn't happened. Inflation's always been low. We haven't had a situation like we had in the 60s. But you will have a huge tailwind from compound interest by dollar cost averaging, because the price inevitably is a very high probability that the price will be enormously higher to where it is now in 10 years. So if you do this per month and you're putting money per month, you're going to have a compound interest because you're buying all the time as the price moves. So you're going to see that per year, you're actually going to make a gain. If the price goes up, you're going to make an extra gain because of compound interest from contributions. And on top of that, you're also gaining in the long term by dividends, mostly reinvesting the dividends. Remember that I don't use dividends for income, use dividends for reinvestments, for capital gains. Because look at the huge difference it made in the S&P 500 if you just reinvested the dividends. Why was that gain so? Because of compound interest, because they're contributions. So imagine if when you're doing these contributions, you're going to, that's why if you hold this for 10 years and you're an elderly person, I don't know the exact amounts, but I wouldn't be surprised at all if you make more than $1 million. I can say that for sure. You can make $1 million doing that if you do this per month. If you do it per quarter, you can have definitely, I mean, I don't know. This is just by estimation, but this probably, I can say for sure more than $100,000. Well, I mean, if you're doing obviously 6,000 per month, you would definitely have, more than $100,000 in a year, right? And that's like very conservative. Like, you'll have more than that, but I don't want to give an amount because I'm not very sure. But that's the effectiveness of dollar cost averaging, right? So what's the point here? Well, I would say the more that you can invest on dollars. That's why I say, look, the first thing that you want to do is try to get the 60-40 rule, right? That's what you should be focused on. If you can't get that, focus on lowering your expenses, focus on what are the items around you and what can I sell, what are not necessary. Let's sell all this junk. Third, obviously, is the mentality. That's like the very, very first thing you should ever do before maybe some of these expenses, because you might break one of these. You're going to break any rule if you don't have a mentality. That's why the mentality is super important, because without the mentality, you're not going to grow with opportunities coming to buy. And of course, remember that I said that, well, if you're able to invest $40,000 per year, you shouldn't be surprised based on history that you can make about $427 million in 92 years, right? So you would have about $500 million. Now, this is where the great thing comes about. This is why I keep saying, I keep repeating, the more money you can put in, the more you'll make out. So if you're a person who has a higher income, and let's say, for example, let's say you're a millionaire, right? Let's say you make $1 million per year. If you're able to put 40% into the market every year, regardless of the price, my God, you would have about, in 92 years, you would have about $4.7 million. You would be a billionaire. You would be a billionaire. And I'm not saying this out of my head. It's literally fact. It's based on history.